If most of your money is sitting in one type of account, especially accounts like traditional IRAs or 401ks, you might be setting yourself up for higher taxes and fewer options in retirement. Tax diversification is about how your money is positioned across 3 different types of accounts, each with different tax rules. The goal is to avoid putting all your eggs in one tax basket. When your savings are spread across different tax types, you're better prepared to make smart withdrawal decisions year by year. So let's walk through the 3 main types of accounts that play into a well-diversified tax strategy. First, tax-deferred accounts are the most common. Think about traditional IRAs and 401ks. You get a tax break when you contribute, but all withdrawals in retirement are taxed as ordinary income. At age 73, the IRS requires you to begin taking annual withdrawals, whether you need the income or not. Roth accounts like Roth IRAs or Roth 401ks are the opposite. You pay taxes up front when you contribute, but the money grows tax-free, and qualified withdrawals in retirement aren't taxed at all. Taxable accounts are regular brokerage accounts or investment accounts. They don't give you a tax break when you put the money in, but they allow more flexibility. You can access your money at any time, and if you've held the investments for over a year, gains are taxed at the lower long-term capital gains rate. Here's a common situation that we see. Imagine a couple in their early 60s preparing to retire. They've saved a little over $3 million, but about 90% of it is in traditional IRAs or 401ks. That means almost all of their withdrawals will be taxed as regular income when they take the money out. If they retire at 65 and plan to delay Social Security until 70, they'll have several years where their taxable income is relatively low. Those years could be an opportunity to make partial Roth conversions, shifting some money from a tax-deferred account into a Roth account while staying in a reasonable tax bracket. They could also use a taxable brokerage account to help cover expenses in the meantime, avoiding large IRA withdrawals and giving their Roth account time to grow. By the time they reach age 70, they'll have a lot more flexibility. They won't be forced to take large taxable withdrawals from just one source. Instead, they'll have options to draw from depending on what makes the most tax sense each year. This is the kind of balance tax diversification helps create. When all your retirement income comes from a single tax-deferred source, your options are really limited. Every withdrawal adds to your taxable income, which can affect things like your overall tax bracket, how much of your Social Security is taxed, whether you hit Medicare premium surcharges, and the size of your required minimum distribution later on. Start by taking stock of your accounts. How much of your savings is in tax-deferred like 401ks? How much is in Roth? And how much is in taxable? Next, look at your retirement timeline. Are there lower income years coming up before you start Social Security or RMDs? Those can be ideal windows to do partial Roth conversions at a lower tax rate. Also consider how long you want your money to last and whether leaving a tax-efficient legacy is part of your plan. Roth accounts, for example, can be helpful from both a tax and estate planning perspective. The idea isn't to rush into changes, it's to look at the big picture and ask, how can I position myself now so that I'm not boxed in later? Tax diversification isn't about finding a magic number or eliminating taxes entirely. It's about giving yourself choices. When tax laws shift or your income changes, you'll have the flexibility to respond, not react. You've saved carefully. You deserve a retirement income plan that gives you control, reduces unnecessary taxes, and adapts with you as life unfolds. Thanks for watching, and if you found this video helpful, please like and subscribe to our channel, and I will see you in the next video. Hi, my name is Justin Haywood, founder of Haywood Wealth Management. And if you're interested in learning about how we help our clients live their retirement to the fullest, visit us at haywoodwealth.com. Thank you so much.